this week's episode of Real Wealth Real Estate with Alex Wilson, broker of record of Remax Wealth Builders Real Estate. And today, I've wanted to talk about this topic for about the last 6 months. It's been in my head doing a video about it. It's how we can use real estate as an inflation hedge. When monetary policy changed at the beginning of COVID, and the government ended up using all the stimulus packages to uplift the economy, I sent an email to one of my old economics professors because my concern was, what is inflation? What is all this money going to do? Will there be inflationary pressures because you're introducing all this new money to the economy, and how will this impact interest rates? So now that I sent that email in March 2020, we are now mid-October 2021, and now we're starting to see impacts from some of this. So I really wanted to dive into this topic now, and what I've done, I brought on the real estate economist himself, a legend in the industry, Remax broker owner, Jamie Johnson, but also has a background in banking, has a background in lending, spanning decades, and his degree is in economics. And the great thing about Jamie is he's always been right when it comes to the real estate market, because he's seen it all. He's seen everything. He's seen the 70s, the 80s, the 90s, the 2000s, the 2010s, and now we're in the 2020s. So without further ado, bringing Jamie on. Jamie, thank you so much for chatting with us today. And we've had many chats over the last 12 years.
Absolutely.
And when we were having a general chip chat before, so Jamie and I, we would sit at tables, and this was in probably 2014, 2015. Private equity guys would fly up from the States, from New York, and they'd always want to know, hey guys, when's the Canadian real estate market going to crash? And they wanted to short the market. So these are topics that Jamie and I have talked about for years and years and years. But the one thing that we've got into before is talking about inflation and real estate. So Jamie, why don't we talk about why there's inflation right now?
Well, I think there's inflation a number of reasons. One, as you pointed out, the federal government just started printing money like crazy. So there's all sorts of money in circulation. Previous times when they printed it, the money ended up into just a few hands, the wealthy hands. This time, what the government did is they pushed all the money out to everybody in the economy. And guess what? They're going to start spending it. I mean, we're already seeing increases in wages. Even in my company, everybody's pushing for much bigger raises than we used to do. And just look at the cost of goods for anything you want to buy. It's already moving up, and you've already heard about the supply chain issues. So definitely we have inflation, and even the Bank of Canada governor just recently said instead of a temporary inflation, he thinks it might be a little bit longer than that. So you know what that means. He's gradually preparing us for inflation that's going to run a few years, I think.
And when you saw the monetary policy, when they printed money, did you expect something like this to happen? When it happened about a year and a half ago, seeing all this money being printed, because it's got to go somewhere, right?
Yeah. Well, if you remember in the economics, how you judge inflations, it's the supply of money times the velocity of money. That's the turnover, and that if that stays constant, then what happens is prices tend to change. But if you go all the way back to 2010, when we had the financial crunch, both governments threw a whole bunch of money into the economy, but the money all ended up in wealthy people's hands and big companies. And what happened was, as we increased the money supply, the velocity of money dropped at the same time. and hence you had no inflation basically back in 210, 212. And that's because, wealthy people can only buy so many suits or eat out so many dinners, right? So they just started to hoard the money, and so the velocity went down. This time around, the velocity of money is moving back up as they print more money, and it's all ending up in the whole economy. So everybody has more money to spend, and if you put more money out there, and they're all running around the same items, chasing the same items, then you're going to have inflation,
And then
and the
add and
government. Sorry.
oh no, and then added to that, which the temporary part to add to that, which that's a permanent. That money is always there. The temporary
Yeah.
part of that is the supply chain, right? So you have increased velocity of money, increased demand, people want to spend it, but our supply of product to spend it on has decreased, which
Yeah.
which is putting more price pressure on everything.
Yeah. Just as a little aside there, in terms of dealing with that, like all these things are great for real estate. For example, there's a 2-year waiting list to get a swimming pool. So if you live in a house and you got young kids and you want a swimming pool, you got two options. You can wait 2 years and do nothing, or you could move today to a house with a swimming pool. So swimming pools used to add no value. In fact, sometimes they added less value to a property. I would say today you'll probably get some sort of a premium for having a pool. Not the full value of the pool, but it won't decrease your house price, it'll increase it. And you'll get more buyers. So all these things are happening, yes.
Exactly. And then staying with real estate. So let's go. Well, let's go into the labor market because you're well into the labor market at being an employer, and we've seen this across the board. Um, and this is where it really will flow this into real estate. You're seeing increased wages. Like if you needed to attract talent, which I know is hard, extremely hard, and you're having issues right now, extremely hard to attract talent to do the work that needs to be done. So you have to pay new people more, and you're having to pay your current people more to retain them. Is that correct?
Yeah, that's right.
So we are
So that's
seeing,
just the labor side. And I
yeah,
know where you're going at.
yeah. So
Now we got to
so
talk about construction materials
oh
at the
yeah, well
bottom.
yeah, that's getting into the replacement costs. We're not even going to go to that yet.
Exactly.
But just so people understand. So what we're seeing, and this is stuff beyond the headlines. This is people that are on the street. What we're seeing, and I've talked to many people, many professionals, many business owners across Canada, is that there aren't enough workers and wages are going up. And what has happened is that it's not that people are at home being lazy, is that a lot of people upgraded their skills or have moved into different areas. So there is now a labor gap, a labor shortage because immigration has been shut down for a year and a half.
Right.
So we don't have the new supply of individuals coming in. We had people leave the labor market to, I shouldn't say leave the labor market, leave certain fields in the labor market to go to different fields. So we had a
Yeah.
readjustment of labor. So now you have a labor gap, a labor shortage, and these aren't things that can be fixed overnight. These are things that will take years and years to fix. And while you have this, that's when you're going to see wages grow because this work needs to be done. And when you see wages grow, that adds to inflation. And then what happens, Jamie?
Add to inflation. Well, we already touched on the construction material side.
Oh no, but
You
I
know,
wanted to go when wages go up and people have more money, what do they end up doing? They end up spending more in housing.
well, they spend it somewhere, and when you really look at it, housing is given COVID and everything else. Housing seems to be the preferred choice.
So now when we look at real estate, how does real estate work as a hedge towards inflation?
Well, that's a great question. I think one of the ways that it's a great hedge is because with inflation, the replacement cost for housing is going to increase. So even if you assume that the market dynamics are totally in balance, like we've talked about the classic supply shortage in housing. just suppose that there was no shortage in housing, right? There's always a need for replacement costs, and that's all rising. So what happens is the existing stock is going to increase, say, just at the rate of inflation. And the beauty about real estate is the leverage aspect. And just think, let's say you're an investor, you bought this $500,000 condo. It really doesn't go up in price, but inflation is 5%. And to build new condos, it's 5% more or whatever. You put 20,000 down, you get inflation of 5% for a year. That means property's worth 525. Your 100,000 equity is worth 125. So what you've done is you've just made 25% on your equity, like 4 times, 5 times the rate of inflation because of the leverage aspect. When I was in the 80s and I worked for a developer, we used to love inflation, because we knew that the product we owned would go up in value, right? And there were things we could do, like we'd lock the interest rates in on mortgages. If you lock all your costs in and then you have inflation at the top end with the leverage, you're really gonna juice your equity. And it that's why I'm amazed in today's market, and everybody is talking about the reverse of that. And I'm saying, gee, back in the 80s, everybody wanted inflation. And when suddenly there was no inflation, all the developers and people like myself were going, oh my God, we're going to be screwed.
Oh yeah, yeah. Like there was a great article. Like, well, actually, I'll leave it. Japan is begging for inflation. Japan has been trying to get cost pressures for decades. Japan wants inflation. The Western advanced economies, inflation is a good thing. That this is they actually want this. Be They want a certain level of it. You don't want it to go rampant, but the inflation is a good thing, because it's going to lead to better buying power and everything. The wages increase, profit lines increase for businesses. As Jamie was saying, when he was in the construction industry, it was good for them in the real estate industry. You need a positive trajectory for growth, so the inflation can be a
Yeah,
good thing. You don't want zero. You don't want negative numbers. Uh, the inflation is what the monetary policy was used for, so it is actually a good thing. So, but what you don't want, where people that don't like inflation, is if you just have cash sitting in the bank. If you just have cash
correct.
sitting in bank, or if you have it in a low interest bearing account, that's where inflation can be bad for you, because every day you're actually losing money. You're losing purchasing power. So as inflation goes up, your dollar is worth less and less every day. So, and that's when we go into real estate and we talk about leverage. By taking that 100,000 on, let's say, a $500,000 purchase, it, we've increased the rate of that what that 100,000 will grow at, because it's the inflation is at the $500,000 mark, but you're only in it for 100,000. So that's how you
Correct.
can you
Yeah.
can use that, and that's where wage growth comes in, because the wage growth allows people to spend more money, to afford the more expensive property, to afford the more expensive rent for our real estate investors out there.
Yeah.
That allows the people that are going to be renting things are the people that are going to have see the highest wage growth. Correct? I would say.
I would say it's across the board. I can remember when I was running this big group, and the controller came down and said we have to average, because inflation was so high. The average wage increase this year is going to be 9%, and inflation was like at 8.5, and we're giving out 9% raises, trying to keep everybody even. But just think, with a 9% raise, right? People have more money, and they're going to make a choice in where they're going to spend that 9%. Not just more on groceries, but now they could buy a bigger house, right? Because their income is higher and they qualify for more. So, you know, modest inflation is really good for the real estate market, because, as we talked about, salaries are rising, so they qualify for more expensive properties, and it's very, very encouraging that way.
And where where we look at it as well, and talking about interest rates and everything. Also, as inflation goes up, um, the value of the debt goes down automatically. So if you
Yep.
borrow $500,000 just today, but inflation is at 5%, the value, the purchasing power of that debt will go down every day. And what's really
And
unique in
it
the market,
depends on what you can borrow the money at too. Like, I
yep, yep,
mean, we've had scenarios where the real interest cost is negative
yeah,
when you look at it. So,
it, yeah,
if
that's
you got
exactly
five
it.
percent inflation and you get a 5% mortgage, you can't get any better than that.
Yep.
That's basically a 0%
E-
mortgage.
Exactly. And who's getting a 5%? Well, the mortgage is less than that. So
Yes, absolutely.
so we're in a very unique time where the mortgage rates are less than inflation. So that means you're
Yep.
borrowing money at a rate that's less than what the purchasing power, the diminishing rate of the purchasing power. So by
Yeah.
borrowing money, you're better off. It's like I've never been in that situation.
Well, as long as you can fund it.
Yeah.
And that's the assumption that people are smart with their borrowings and they have a cash flow to support their borrowings. That's
Oh,
all
of
I'd
course.
say
Oh,
there.
oh yeah. Of course. Yeah. We don't promote speculation here. We always tie in the cash flow conversation to everything, right? You want
Right.
to make sure, and you've been around long enough. Cash flow is always king. Cash flow is still always king. We can have a debate in regards to where we want cash flow to be, whether it's a little bit negative. To offset some appreciation, I preach a neutral cash flow level
Yeah.
for the tax advantages. But what you don't want to do is take in a significant negative cash flow situation, because you only lose money in real estate when you sell. So don't sell
When you're forced to sell.
when you for
If
exact.
you're
So that's a
never
land.
forced to sell,
Never
you'll
forced to sell.
always make money.
Yes. So if you're putting yourself in an extreme negative situation, which I'll give an example because we should always do that. If we look at what happened at the beginning of all of 2020, I shouldn't say beginning of 2020, we saw rents decrease dramatically. So if you were in a very bad situation, and you were a landlord, then you would have been taking a significant hit every month on your cash flow situation. So you do always want to make sure that you're in the right cash flow situation. You're balancing your portfolio and everything.
Right.
I saw my rents across the board decrease about 30% in 2020. Um,
Yeah.
but as long
It's
as you're
interesting. If you'd have been forced to sell
Mhm.
at 2020, right, you would have sold for less than 2019. But
Yes.
let's talk about condos downtown. Prices today are higher than the highest price in 2019. So if you could ride through that 1 year cycle, you're way better off and you're way ahead of the game. And you just have to figure out how to increase your rents. But that's the point. If you're not forced to sell, you're in a much better position.
Yeah.
But that's a key point, Alex, as you make. You have to know that you can manage the cash flow or the negative cash flow.
And we've seen it, and I've been through the financial crisis and now the pandemic. You've seen more ups and downs. The key thing about real estate, and I always take a 30-year view on it because that's when my properties will be paid off with amortizations, is that it always goes like this. We'll have a down,
Yep.
but it rebounds right back up because housing is a fundamental need, and people need roofs over heads. And
Yeah.
this is where things will get crazy. We've just talked about a labor shortage. Borders have been closed for a year and a half, so our immigration has been at a standstill. Immigration is going to happen at the fastest rate we've ever seen in Canada. That is 100% happening. You need the workforce. You need the skilled labor coming in, and you need the economics of that as well. Would you like? They've already said they're going to do it, but it will happen. Jamie, are you any
And then
disagreement
you
with
need
that?
housing.
And then you need housing,
No.
and then you need
And then
housing,
you need housing.
and
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 that's two levels of government. The
and
federals bring them in, and it's the provincial responsibility for housing. What a
Jamie,
dilemma. Yeah.
how fast are they building housing?
They're not building them fast enough even right now for the current. I think there was an article that said we're about in Ontario about a million properties or houses, and I use that collectively, places to live, whether it's a condo, a townhouse, house, or whatever. But we're a million units short right now. And if suddenly we accelerate immigration, the situation is going to get worse before it gets better. So
And
you're absolutely right. And with inflation, you know, people got to put their cash somewhere. Where are they going to put it? You can't just leave it in the bank because you lose money every day, you know. And I don't know about you, but I've done a fair bit of research on Bitcoin, and I'm ready to pass on Bitcoin because I guess for me, the true definition of an investment is something that pays you money every month. You get an income every month.
and
And Bitcoin doesn't do that. It's a hold and see what happens like gold.
yep.
There's
Well, and that's where, we're talking about real estate being an inflation hedge. Uh, Gold can do that, but that's just using that. It's that's an assigned value that someone's
yeah,
putting on that. Whereas real
yeah.
estate can also be an inflation hedge, but you will get a monthly income from that. Someone will live in your property and someone will pay you a monthly income to live in that property. It is the easiest investment I think out there that you can both get a monthly income but also leverage and it's
And
so
get appreciation.
and get
That's the
appreciation. Yeah.
challenge.
Yeah.
What assets give you both?
Yeah, so if we were investing in dividend stocks, right? Can I leverage
Mhm.
that? I can't leverage a
You
dividend
can buy
stock.
it on margin, but you don't get the same margin. You'd be lucky to get 50% margin.
And then you got to assume that people understand buying on margin and everything like that and dealing in that whole
Well,
market.
Well, the real danger that I see is with real estate, you are the market. There isn't some mysterious hand overweighing the market. You go in a stock market and you're the little fish and someone else is dictating prices and everything else. You know, and even the big guys get hurt. All you got to do is look at GameStop,
Yep.
and all the little guys got together and went after the short sellers. And the short sellers, in terms of fundamentals, were absolutely right. The stock was virtually worth nothing. And these guys drove it the other way. So you could buy a stock in the stock market. You could be perfect on your analysis. And somebody you don't even know can manipulate the stock in another direction.
Yep.
So I've always been very cautious of the stock market in terms of investing in some of the things in the market.
Yep. And
That's
that's
I
what.
get another point about real estate. Real estate, I feel, hey, you're the market. You set the market. You can see what's happening, and there's not some mysterious third hand going to manipulate prices or manipulate supply or do whatever.
No, it's that's exactly it. So even if you buy at a top end of the market, let's say 2019, which was a top end of the market, and then we
Yeah,
saw a dramatic decrease due to worldwide events the next year.
yeah,
But as we pointed out, if you waited a year, you were fine, and the market, the prices exceeded what 2019 was now in
yeah.
2021. And all you just needed was you had that income, you had someone living in the property during that time. That's what I said to people. I'm like, okay, even if you're losing monthly revenue in 2020, I know this isn't going to last. I know people are coming back to downtown Toronto because downtown Toronto was the one that was the area that hurt the most. Downtown Toronto's not going anywhere. So let's say you're down $300 per month. So $300 per month times 12 is $3,600. Okay, you're down $3,600. But you're going to make 100K in a year. What would you rather take? Down 36 or up 100? I'll take up 100. And it happened. It was a no-brainer because these are things that you can predict. You can predict, I would say, real estate fairly easily based on a long-term trajectory, on immigration stats, on
Yeah, the
economies,
demographic.
on
Yep,
demographics,
yep.
all those things. You can predict a very stable return in real estate and have that income that comes across. And as I say, you can leverage that asset. You can leverage your house, which has gone up in value. And if you find the right cash flow positive asset, you can make money on the increase of value in your current home using your home equity line of credit. There are, which we've talked about in previous videos. There are many ways to do that in real estate, and the banks support this. And let's jump into that quickly right now. So Jamie, and we've talked about this before with the banks have to lend you the money because they need to make their profits, right?
Well, very simply, understanding the banking model, they're certainly making some money on fees, but the original banking model was they take in deposits, whether they're GICs or bank accounts, at one rate, and then they lend it back out at a higher rate, and they make the spread. So if everybody just put money in the bank and they can't lend the money out, then the banks are going to lose money, right? So, particularly the Canadian banks, you have to look at where Canadian banks go in terms of where do they push money out to lend, right? And really and truly, if you look at it and strip it away, they like mortgages and they like credit cards, right? And if you look at the mortgages and the principal residence, it's amazing Canadians, if they get in financial difficulty, they won't pay their credit cards. They won't stop paying their car payments. They'll never stop paying their mortgage. And the banks know that, right? Like you just look at the loan loss, you just look at the loans in arrears at the banks, and they're minuscule. They're so tiny. And when these banks set up these loan loss provisions, like everybody panicked in 2020, right?
Mm-hmm.
Oh, we got $1 billion for bad loans. They set it up. You know why? Because they did not want to show excess profits when everybody was struggling. So they set up this loan loss provision just to say, hey, we're at the same profit level as the year before, right? We're working really hard to do this. And guess what they start to do? When the loan losses don't materialize, if you set aside, let's say, $100 million in loan loss provisions and you only lose 50 million, you add the 50 million back into your income. And that's how banks smooth out their profits all the time, just through that little maneuver. And, you know, because the banks know that they're going to have very few defaults on mortgages with them.
It,
So uh, banks will say one thing, but mortgages for them are bread and butter.
and going into talking about taking money in and then lending it out, deposits generally deposits run at about $40 billion. They're over 300 billion right now in the banks.
Yeah. So they
Uh,
got to push it out, right?
yep, yep, yep. And again, these aren't things that get fixed overnight. There are these are fundamental things that COVID has brought to our systems. There's been a shock to
Yeah.
the system, and these are going to take years and years and years to smoothen things out and everything like that. And while we
Right.
wait, we'll see inflation to continue to. We're not going to see a crazy level of inflation, but we'll be around where we're at. I don't know for how long. And the best way to protect against that is by buying real estate, because you're leveraging, you're using leverage as an advantage to fight the inflation. Your debt will be worth less in the future. You're borrowing at a lower interest rate than what the inflation's going up, and on top of that, you're getting a leverage return on your asset. And we know that we're going to have record levels of inflation coming. I'm not record levels of inflation coming. Record levels of immigration coming. For me, it's a no-brainer, especially when you find the right markets to invest in.
Yeah.
So
Yeah. I
Jamie,
agree. I
oh, good.
agree
Yeah.
wholeheartedly.
Oh, what'd you
Agree
say?
wholeheartedly.
Yeah.
And I just my final thought to
Hmm.
people that are watching. I was in the market when mortgages went to 19%. They're not going to go that high. But the market was red hot when mortgage rates were 8 and 9%. So what I'm telling you is don't get nervous about jumping into the market if mortgage rates are suddenly 3 or 3.5%. And you could have got it at 2. And that's my point. If you can handle it and your salary's going up, then don't worry about a 3% mortgage.
Oh God, that made me laugh because right before COVID, January 2020, I signed 3% mortgages. So yeah,
It's
you're like people worrying about 3% mortgages. I'm like, I signed those less than 2 years ago,
well,
so I'm
and
not worried.
did you do fixed?
Yeah.
Hey, hey, look, if you're going to be an investor, you got to go
Oh
variable.
yeah, yeah. Oh,
I'll tell
and
you that.
oh,
I
you.
variable for everything, but
Yep,
particularly if you're going to be an investor, go variable because you don't know when you have to sell or not, and and the penalties from fixed rate are astronomical.
yep,
That's
yep,
another area where banks love people taking fixed mortgages and hitting the penalties. Like the penalties, believe it or not, I've seen on closing statements with some of our deals where the interest penalty has been like $30,000 and $40,000 interest penalty on a mortgage, and
yep,
the guy can't believe it. And his mortgage is only like 600,000.
yep. That's
Right?
you only lose money when you sell. So don't put yourself in a situation to sell. So yes,
No,
that's a whole nother.
but all I'm saying is
Oh yeah.
variable is the way to
Oh,
go.
I know. Hey, I've learned my lesson a few times. A few times.
Well, I'm
That wasn't.
learning all the time too, Alex.
Yeah, yeah,
You're never
yeah.
stop learning.
Jamie isn't saying this from sitting on a throne above everyone. He's saying it from years and years of experience in making these mistakes himself.
Absolutely. I always tell people I'm not there. I've just made all the mistakes. So learn by my mistakes. That's
Yeah,
all I'm saying.
yeah. Oh,
Yeah.
so Jamie, thank you so much. Really appreciate it providing that insight on why real estate is a great hedge against inflation, the
Yeah.
inflation pressures that we have coming. And we'll probably have you on again because we touched on so many
Sure.
other topics that we can have a whole nother chat on.
Yeah.
So thank you so much, Jamie. We'll
Absolutely.
chat soon.
Whenever. Thank you
Okay.
very much. Have a
Okay.
great
You
evening.
too. Bye bye.
Bye.
So, everyone, thank you so much for coming online. Remember, subscribe. Alex J. Wilson on YouTube, and check out our podcast, Real Wealth Real Estate with Alex Wilson. We'll see you next week. Bye bye.